It's going to get worse. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, following the biggest one-month crash in history, the U.S. manufacturing sector is now in complete freefall. We're going to show you what is causing the problem in the manufacturing sector and why it's going to get far worse before it gets better. And is the dollar about to come crashing down? Well, one expert says yes. We'll take a look at why he says that and why we think he's completely wrong. And is the U.S. economy about to rebound in a major way? Well, this commodity says not a chance. Let's over to the New York Fed, where we picked today's story up. We're going to take a look at the Empire State manufacturing sector. Now, this is a survey between May 2nd and May 9th. So this is very recent data. And this is very interesting because we're seeing the biggest one-month crash in the data, excluding, of course, during the pandemic when everything came crashing down. So we should not be seeing this. You know, we keep hearing from policymakers and experts that we're only seeing a soft landing, and maybe from the Fed's perspective, maybe even just a no landing because the labor market is staying so strong. And if that was the case, we should not be seeing an outsized move to the downside in any sort of manufacturing survey. And well, we just did. Business activity fell sharply. Now, I want you to be thinking these are not things you hear about in an expansion or rebounding economy. Fell sharply in the New York State. The headline, general business conditions, dropped 43 points to minus 31.8 as new orders and shipments plunged after rising significantly last month. Delivery times shortened somewhat and inventories contracted. Both employment and hours worked edged lower for a fourth consecutive month. Prices, you're talking about inflation here, increased at about the same pace as last month, while capital spending plans turned sluggish. Looking ahead, businesses continue to expect little improvement in conditions over the next 6 months. And this is a horrible report. I mean, that's just the introduction of what they're saying here, of what's going on in the New York area, and the manufacturing sector is in a free fall here. But did we know this was likely to happen? Well, we did. Because when we go back and compare this to the Philly Fed manufacturing survey, well, we can see that last month, the New York Fed had a big move up and was likely to come crashing down. And here you can see we have the Philly Fed general activity against, of course, the New York general business conditions. That one showing in red, Philly in blue. And you notice they kind of move together. They're both very noisy. They move up and down quite a bit. But notice they follow a very similar trend. But you come back here, and last month, everybody was excited because the New York report showed a big surge higher in manufacturing, suggesting that perhaps the economy was turning around. The Philly Fed said, no, we don't buy that deal at all. And the blue line, you notice, has continued to head lower. And what all of a sudden happens, we see this sharp move down in the manufacturing sector here for New York, suggesting that, as we've known, that these other regional Fed surveys were right. And of course, whatever happened in New York last month was just a one-off report. Because let's look deeper in what's going on here, because it's just downright ugly and suggesting that the manufacturing sector is in the beginning phase of a major downturn. And here you can see, looking at shipments as we dig into this a little bit, you'll notice that during the pandemic, you'll see this came crumbling down. Of course, it made sense. But notice now shipments are in contraction. They've been in contraction. How about unfilled orders? We talk about this being a component for inflation. If you have a lot of unfilled orders, well, you can raise your price. We see that too is now back in contraction and been that way since the middle of last year. How about delivery times? How fast things are getting places? Well, that's in a contraction. Again, suggesting that delivery times are shortening, inventories are starting to fall. Again, none of these are signs of inflation, booming economy. Now you see prices paid are remaining rather sticky, but we notice that producer price index is suggesting this is likely to come down. Prices received are about the same level, but notice this, a number of employees, we've been seeing a bit of a contraction here that validates what we see in the payroll reports that say manufacturing jobs are kind of slowly going away. And on top of that, you have average employee work week is in contraction. So here what you see is kind of the first move is when your backlog shrinks. Well, Well, you don't need as many hours to be worked, so you start cutting hours because you don't want to cut employees until you have to. Because remember, everybody really believes in narrative that, hey, we're just going to have this soft landing. The Fed, maybe for the first time in the history of the Fed, could get this actually right, and we don't want to let these employees go and then have to try to bring them back and train them again. We'll just start cutting their hours. But at some point, what you'll see is not just a little bit of trimming of employees, you'll see a whole lot. I want you to see why we're making this case that the manufacturing sector here in the U.S. is about to see a major downturn. Because when we start to look at what's going on, we look at the yield curve here. We're going to overlay the 10-year, 2-year yield curve. That's shown in the green line, with the inversion showed just below the horizontal purple line. And we've got that again against the Philly and New York Fed general business conditions. And what I want you to note is when you see inversions like you did here in early 2000, that signifies a collapse in manufacturing. You see it happen almost just after that starts. You'll notice here in 2006, an inversion started, but it wasn't a deep inversion. It was kind of at parity. Business conditions held on, and next thing you know, you start to see a steepening of the curve. Business conditions come falling down. We'll note here again, you start to see the curve in late 2019 start to get close to inversion. You see a slowdown in the manufacturing sector. The curve steepens. That downturn still holds, and now you're seeing it again. The massive inversion we've been warning about, we're seeing in the manufacturing sector and play out, because when you understand, banks make money by borrowing at the short end and lending at the long end. So when you see this inversion, you don't get money created. You don't get as much money created because it's not profitable. And in a debt-based economy, expansion of debt, expansion of money is what makes prosperity happen. So when we start to see these curves inverted, it suggests that there's problems in the financial system. And we're going to talk about how the Fed could fix this, but we're also going to first look at why they're going to make it a whole lot worse, or at least they're indicating to us that they want to make it a whole lot worse. Fed's Bostic Goolsbee favored policy pause to watch credit impact. Well, I think we're going to show you there's an impact, and it's probably about the size of a meteor at this point, and not a small one, that's going to hit the economy because they really have no idea what they're doing. I'm going to make that case here of why, again, things in the manufacturing sector are only likely to get severely worse. My baseline case is we won't really be thinking about cutting until well into 2024, suggesting that Raphael Bostic believes that they're going to keep rates elevated all the way into next year. I don't think they stand a chance at that. And if you look at the most measures of inflation, we're still 2 times where our target is, and that's a long distance to go. And it is a long distance to go, Raphael, but the other side is you're missing the point. You can't rapidly move inflation down in a huge economy like the U.S. economy. It just doesn't move like that. We have no historical reference outside of an outright financial crisis. Now, if that's what you're trying to do as one of the members of the Fed, we'll keep it up. But outside of that, we should just see a gradual reduction in inflation over time. And we are seeing disinflation, but here's what they don't get. They still want to raise policy rates. And notably, when we start to look at these general business condition charts against the federal funds rate, here's what I want you to see. When the manufacturing sector slows down and contracts, what happens to the federal funds rate in green? It goes down. You see it happen here going into the global financial crisis. The manufacturing sector slows, Fed cuts rates. You see it here in the pandemic, going into the pandemic, but prior to that, remember, there's a major slowdown. The manufacturing sector comes down, Fed cuts rate, and look now, the first time you're seeing this in the data that we have on these regional Fed surveys, and notably, what should the Fed be doing right now? They should be cutting rates. What are they not doing? Talking about either keeping rates up or potentially even raising them higher. There's still a lot of the impact of the 500 basis points we did last year that's still to come. Yeah, you're right. There's a bunch. And if you add that there are tight credit conditions. And I think that we should be extra mindful. He said we need to take that into account. And the only way to do that is to sit and watch. Well, we're going to sit and watch this thing implode, because notably we go back to the yield curve. And what is it telling us? Whenever you see an inversion, what happens is you see the blue line. This is now the yield curve steepen, suggesting market rates are coming down and the Fed chases them lower. And we see these inversions. The Fed cuts rates. The inversion, the Fed cuts rates every time, because if you think about, what is a curve inversion, it's when the 2-year yields are higher than 10-year yields, or whatever your spread of yields you're looking at. You see short-term rates being higher than long-term rates. Well, what would be the one thing that you could do if you were in charge of the Federal Reserve and largely in control of the front end of the yield curve, where we're seeing higher interest rates causing a problem and the inversion against long-term rates? Well, you could cut them. But what are we seeing? No sign that they want to do that at all. And if I had to bias between going up and down as our next action, I would say we might have to go up. Again, making this inversion potentially even worse. What we've seen is that inflation has been persistently high. Consumers have been really resilient in terms of their spending, and labor markets remain extremely tight. All those suggest that there's still going to be upward pressure on prices, but that is not my base case either. So again, they come back to the labor market, which we've shown can and does look strong going into recessions. They're talking about spending, and that we're seeing signs in the credit card data that it's collapsing. And so all of this is to say is the Fed should be looking at the yield curve here, looking at the manufacturing data and saying, you know what, we see a problem here that we could easily at least attempt to fix by cutting rates, but they're so fixated that inflation has to rapidly come down. What they're only going to end up doing then is triggering an all-out banking crisis, as we've already seen the beginning phase of, that's going to lead to a massive deflationary shock, one which the Fed will have to cut so rapidly down to zero, they'll be too late to fix it, and it will be all game over from there. But one thing we should see upward pressure on, and that is your trades after you put them in. We have our CTA-Timer Pro report out today. Over the weekend, we put out a weekend watch list. I've walked through the report showing people how to start finding things that are at historical lows. We look at the computer models, we make an adjustment based on all the historical data and say, look, if you're looking to buy low and sell high, start your watch list with these, and then when you see the signal, see them rising, jump in. It will increase your odds of success immensely. So check it out. It's still $30 a month, headed to 40 at some point, as we're seeing signs of tightening that needed to happen. And now the question is, how much of that is really going to bind on activity, Bostic asks. The appropriate policy is really just to wait and see how much the economy slows from the policy actions that we've done. And yet when you look at these regional Fed surveys, when you look at the yield curve, you look at all of the data, you say it's very clear the economy is slowing down. What we haven't seen is it impact the labor market in a big way. We're just starting to see initial claims move higher, but yet beyond that, we're not seeing all the evidence the Fed wants. But what we can see is the economy is clearly slowing down. And when you now then take this and talk about, tightening lending standards on top of this, we're going to take those general business conditions from Philly and New York, same colors as before, but now overlay the net percentage of banks tightening standards for commercial industrial loans. And what do you notice as a fantastic relationship as banks start to tighten lending standards up? What happens? You see a slowdown in the manufacturing sector. You can almost start to see them move in sync with each other. And now what are we seeing? Of course, banks are tightening lending standards. It's above this horizontal purple line. It corresponds almost perfectly with a slowdown and now a downturn in the manufacturing sector. And what did we note from the other day in our show? We talked about how the Fed's SLOOS report, the Senior Loan Officer Opinion Survey, it said, hey, we think from the bank's perspective that we're going to be tightening standards through all the way through the end of the year. Of course, it makes sense if the Fed is intent on keeping the curve inverted. Well, banks aren't going to want to lend. The manufacturing sector isn't going to get the money it needs because demand from consumers is not there. And so you start to make the case now of why this is only going to get worse. But is the dollar going to crash as a result? Well, let's take a look, because a lot of people are saying it has to do with the debt ceiling. But some good news now, Biden says debt talks are moving along as parties discuss changes, as we said, would likely happen. But plunging tax revenue accelerates the debt ceiling deadline, so you have another indication of a weakening economy. If the economy was booming, we should see an increase in tax collections. We're seeing a slowdown here, but what does that have to do with the dollar? Well, one expert says it means it's coming down, as the dollar's bounce may slam into the debt ceiling, he says. The possibility that the impasse between the White House and the Republican leadership in the House of Representatives ends in a default for Treasury debt would, on the face of it, be a mighty strong deterrent to buying dollars. If that is so, then the single biggest political risk of the moment isn't helping the currency. But what if that was completely wrong? Because let's go back to the charts. Remember, we came very close to a default back in August of 2011. And lo and behold, what do you see here? The dollar went rallying, not because people were afraid of it, because people went there as a flight to safety. That's why yields came down. That's why stocks came down. So one of the risks we're talking about here now from the market perspective, we talked about the risk of a rising dollar on Sunday's show. If you missed that, go take a look at how it could bring equities down, commodities down. And what have we seen here is the evidence shows that as this draws out, that there could be a big flight to the dollar. That would send, of course, the dollar higher, and stock prices likely a whole lot lower. Of course, that's what we think now could be the base case. Experts say no. We say we think they got it wrong. But now is the economy about to rebound? Well, this commodity says not a chance. As oil prices sink, as economic concerns continue to dominate the markets, fears of a U.S. debt default are the major economic factor pulling oil prices lower. Well, if we go back to 2011 and take a look at those general business conditions from Philly and New York, what we can see in 2011 is crude oil did rally in 2011. So you can make the case, well, wait, the debt ceiling is bullish for oil. But what I want you to see, it was bullish because manufacturing demand was increasing. We know that when manufacturing demand decreases, a business activity falls, what happens is oil prices fall after that at some point or along with it, suggesting that oil prices aren't going to be recovering anytime soon, particularly as we're seeing companies drive for expanding margins are threatening the future freight demand. Again, that's not a headline that says demand for energy at all. As the PPI does the transportation cost component to it, so it is not surprising that after truckload freight demand, measured by the outbound tender volume index, collapsed in March of 2022. The question, my friends, is what happened in March of 2022? Well, you might already know the answer, and that is the yield curve started to invert. So what we're seeing is everything we know as the banking sector, the bond market is telling us much worse things are unfortunately here to come, unless, of course, the Fed acts now and starts to cut rates. But even then, I think it'll be too little, too late. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.